Ladies and gentlemen, it's a great pleasure having you here for our Q4 2023 advisory board meeting. And it's an even greater pleasure to have Lyn Alden here for the second time, actually. Lyn, thanks for taking the time.
Thanks for having me back. Happy to be here.
Lyn, it's just the two of us. Jim Ricketts, due to personal reasons, has actually canceled. He's well, no worries about that. And Mark is also, he caught a really severe cold, so he's sorry for not attending, but he sent me some really clever questions that I will ask Lyn in the next couple of minutes. And today is Monday, the 4th of December. Gold has actually made a pretty significant all-time high. Traded above 2170 in the early hours, but then made a pretty interesting reversal. So lots of topics to discuss today with Lyn, and I really look forward to this discussion. Just some housekeeping, what's going on our end, actually quite a lot. It's very busy as always before Christmas. I attended lots of conferences. I did a keynote at the Dubai Precious Metals Summit, another one at the Precious Metal Summit in Zurich with all the mining companies, obviously. Then I visited a family office conference in Portugal. We're currently setting up a new fund, a very active gold fund that invests in the whole spectrum of the gold universe, especially the mining space, but not a stubborn long-only approach, but rather a very active one. So that keeps us very busy. And then obviously our existing funds, especially the two funds that combine Bitcoin with gold, are doing tremendously well at the moment. So we're quite busy with meeting new and existing clients, potential clients. We're already working on the 2024 In Gold We Trust report, obviously. We will put out a new chart book on gold very soon. As you know, we've got a quarterly Bitcoin chart book now as well. So yeah, it's not boring over here. But I now really look forward to talking to Lyn. Lyn Alden is, I think we don't really have to introduce her. She's the founder of Lyn Alden Investment Strategy, where she basically provides retail and institutional investors with research for actually a variety of asset classes. And she has become a superstar on Twitter with, I don't know, how many followers do you have on Twitter, Lyn?
About 650,000 right now, but with those kind of things, who knows which ones are real and which ones are not. I mean, the engagement's decent, but yeah, I have my website, I have Twitter, I'm also on Nostr. There's a decentralized social media protocol that does other things too. So I try to get around.
No, you're really, and I know that lots of people that I highly respect in the industry do extremely respect your work and your efforts and your views on the market that are slightly different, perhaps because you've got an engineering background. But therefore, I really thank you for joining us again. And actually, let me start, Lyn. With your new book. It's called Broken Money. It's 500 pages. It's an excellent read. I'm not through the whole book. I'm somewhere on page, I think 270, 280, so roughly 50%. But I love it. And you going through monetary history. One quote that I like where you say gold is actually the king of commodities. And like in the game of chess, the king may be the most important piece, but the queen is the most useful piece. That's what you're writing in regards to silver. I think that's really nice wording, but I think it's really a must read for everybody that is interested. Not only in sound money, but in our monetary system, in the topics of inflation, asset allocation in this environment. So it's really highly recommended. And big congratulations on that fabulous book. We talked
Appreciate
about
that.
that before. It's lots of work writing a book, and it's even more work editing it. And so I know that there's countless hours of time in this book, but you can be really really proud, and I think it's already quite a success. Lyn, could you briefly explain? I know it's not easy, but what was the idea behind the book, and why did you come up with the title Broken Money?
Yeah, so as you said, basically writing a book's very time consuming. So my advice is generally don't write one until you feel like you can't not write one. So basically I have so much research content over the years. So of course I get questions like, you're going to write a book, or I haven't thought about writing a book, but the sheer thought of it, the time consuming aspect, I'm like, I'm too busy right now. It's not usually the best ROI. It's something you do. It's more of a labor of love. But eventually enough specific themes kind of formed together from all of my research. And I got a lot of questions like, where should you start with your research? You've done kind of so much for so many years, and of course, over time, some of the pieces get a little bit dated, some of them change. It's hard to know where to start. And so I wanted something kind of more holistic. That kind of summarizes my view on a lot of things and presents new things that I haven't really written about. So I can say, well, here's where you start. You read Broken Money, and that's helpful. So I wrote the book because I could not write the book. It was like my kind of just highest calling that year. It was the thing that I would get distracted thinking about, that I always wanted to work on, that I would get in a flow state while working on. So Broken Money, the core theme is viewing the past, present, and future of money through the lens of technology. So a lot of monetary history books focus heavily on the political decisions, which are important. They affect the timing of all sorts of things. And which country gets ahead of another country because they made certain strategic decisions ahead of time, or things like that. But I think even the bigger theme is how technology drives things, right? So politics can affect things temporarily and locally, whereas technology drives things forward kind of permanently and globally, right? So if you invent refrigeration, for example, that changes almost everybody's lives in the world. Whereas other decisions, and permanently, as long as we don't have like a civilizational collapse, we never unlearn how to do refrigeration. Whereas a lot of other political decisions are more temporary, more geographically constrained. And so I focus heavily on that technological aspect, especially given my kind of combined engineering financial background. I'm not a political historian, but viewing it through the lens of technology is helpful. I was also really fortunate to have Joachim Book be my editor. He has a master's in financial history from Oxford. In addition to my work, I basically a proper historian helped me research, fact check more than just edit. He played a key role in helping elevate the quality of the book to a level that's, above what I could have gotten if I didn't have a really good fact checker and source expert. Um, and so basically, the key theme is money through the lens of technology, past, present, and future, with a couple key sub themes in there. So one key sub theme is to kind of look at how credit theories of money and commodity theories of money are kind of describing the same thing, but in different ways. It's kind of that fable of the elephant. There's like three blind men that are touching parts of an elephant. One's touching the tusk, and one's touching like the leg, and one's touching the tail. And they're all arguing about what they're touching, and they're all getting a subset of the elephant, right? And so I kind of view credit money, and I just go through that process of what is money, what is credit money, what is commodity money, and how are they kind of interlinked. Another key theme, especially technologically, is the idea that the invention of the telegraph had a much bigger role on monetary history than many people realize. Basically, prior to the telegraph, sending information long distances, especially with high bandwidth, so anything other than like, fire signals in the night, but sending information long distance was inherently a slow process. It could only move at the speed of matter, so ships, horses, and foot. Um, and so gold and silver and kind of physical monies and information moved at roughly the same speed, even though some paper instruments could make it more efficient for verification and travel and stuff. But with the invention of the telegraph, that speed gap completely blew open. So we could now communicate worldwide, especially, what over decades once these telegraphs cables were actually adopted and go across the oceans and things like that. And of course, all the technologies that have come since. But ever since we entered that telecom age, the ability to send information very quickly around the world means we can also perform transactions around the world. But we can't settle those instantly. We can't just teleport gold to somebody, and so we increasingly relied on more and more abstraction, more and more chains of credit. And gold would more tend to be centralized and rarely kind of taken out of the banking system, because if it's in the banking system, if you have a deposit rather than say gold coins under your mattress, you're now part of this interlinked system, and you can send money and receive money far more readily. And so kind of a big part of the book focuses on the implications of that speed gap. Some of them are good. I mean, it's obviously good to have fast communication, telegraph, link the world together, but then it did have some negative implications for money, because it basically gave bankers and central bankers a lot of arbitraging power for that speed gap relative to the verification and physical transport and settlement of gold. And so it kind of takes a somewhat technological determinist view of why not just some countries left the gold standard, but basically every single country left the gold standard, because even though gold was a really good savings asset, that speed gap was very difficult for it to overcome. And so that's a big theme. And then obviously the last part of the book gets into things like Bitcoin, stable coins, central bank digital currencies, all the kind of the two main paths of a digital money future we have. And it kind of focuses on the last point is like in the current system, there are 160 different fiat currencies, roughly. And they're all like these little silos. They all have a local monopoly on their jurisdiction. They have very little salability outside of their jurisdiction, except for the dollar and a few other top currencies. And that is largely enforced due to the legacy system. So you can only really get money in size in or out two ways of a country. One is physical ports of entry, so you can bring cash or gold through an airport. Obviously, you're usually tightly limited there, usually under $10,000 worth, sometimes less. And the other way is wire transfers in or out, but those are completely controlled by, government central bank regulations. And they get to decide, if I send dollars to someone in another country, does that person receive them in dollars, or do they get converted to local currency at the official exchange rate, whatever it might be. And even fintech companies are just really mostly just overlays on top of the correspondent banking wire system. They just basically have accounts in multiple things and can make those go quicker, but they're still usually relying on the underlying banking. And with things like Bitcoin and stablecoin, and there's even gold-backed stablecoins. But what all these technologies do is kind of crack open these 160 different silos and allow monies to compete globally once again. So someone in Nigeria can now, you can bring infinite value density of Bitcoin or stable coins through an airport by memorizing 12 words, for example. Or if I pay a graphic designer in Nigeria, she can hold up a QR code on a call just like this, and I can pay her, and she gets it could be Bitcoin, it could be stable coins, whatever she asks her for in her invoice, she can receive. And it just goes around her local banking system. As long as, from my perspective, as long as like I'm not breaking any American laws, like I can't really necessarily hire like an Iranian graphic designer, but as long as I'm not sending money to a sanctioned country, this is now a method to get value to someone in the money she wants rather than being stuck with the local system. And as long as she has access to email, DMs, video, and basically internet connection, she can now bypass those prior two methods. And so the world's becoming more interconnected in terms of money. And I think that has big implications going forward.
Lyn, I think the question and the discussion, what is money and what is good money, is money broken, or why did money break? I think that's really crucial discussions, and that's also why I really enjoy, so many mostly younger Bitcoiners coming in and discovering and discussing the topic of money again. I think that's really one of the great developments that the whole Bitcoin development has brought to us. Let me ask you one thing, Lyn. You're currently, you said, in New Jersey, but you've got family in Egypt, and I always kind of see that when I'm talking to US investors about the topic of gold, they've got a completely different attitude. While if you talk to people in Germany or in Austria, for example, where we had the hyperinflations, where we had currency reforms, gold is much more than it's like a monetary insurance. And I think that people here are still, from all the stories that we heard from our grandparents, the hyperinflation and the currency reforms, they're still somewhere in our monetary DNA. While in the US, I think it's mostly the Great Depression and the threat of deflation that has kind of traumatized people. So, with your background from Egypt or family in Egypt, did that to some degree affect your thinking about money and when you started questioning money and asking the question, what is good money, what is sound money? Did that have an impact, or was it something completely different?
Well, it certainly helped refine it. I've been thinking about that before then, but it helped me clarify some of the details and realize how siloed monies are. And so, I was lucky. I mean, it's funny because I'm still fairly young, but when I was a kid in the 90s, my father would give me some little like gold and silver coins as like Christmas present and things like that. So, and I started coin collecting because my uncle had this like box of like world coins, and they weren't worth anything. I mean, they're all like the normal coins, but it's okay. This one's from Turkey. This one's from Canada. This one's from Mexico. This one's from China, and it's just like this box of kind of exotic. It's like a history book in metallic form. It's really fascinating, and so I just found that interesting. The uncle kind of had like if anyone's seen the commercials about Dos Equis, the most interesting man in the world. It's like a character. And my uncle was kind of like that guy. It's like this kind of just like charismatic uncle sort of person with this like exotic coin set. And so I started my own little kind of worthless coin collection that I just found very neat as a kid. And then I naturally kind of gravitated towards silver and gold coins over time to actually start. Once I was kind of old enough and conscious enough to understand what gold and silver are. And so actually I got into gold and silver at a young age, back when gold was like $300 an ounce. And so it's always kind of just been there for me. Um, I started to realize money was broken in some sense back in around 2017 or so, um, because we started to get a widening fiscal deficit in the US, even though we were not in a recession, which had not really happened since the Vietnam War. That was and it continued in 2018, 2019. And so I started looking more into how do sovereign debt bubbles end? Like prior to that, I was like, well, eventually they print it or something, right? But it's like, okay, actually mechanically, what does this look like? And what time frame and what are the factors and what to look for? So I started to do a multi-year deep dive. And that's actually what kind of led me to transition away from mostly focusing on equity investing to more focusing on macro, money, energy, that kind of stuff, because I realized that we're entering a unusual macro environment that, it's like the type of decade that kind of changes a lot of things. The bigger the normal things happen that history books kind of focus on more than other decades. And so in other words, I was like, this is gonna be a more macro decade than the 90s were, for example. Um, and so that was kind of like the initial starting points. And then, of course, kind of like studying Bitcoin over time, seeing how that works. I always found it neat, but I was like, I mean, the chance that any sort of like new techno money is going to work is obviously very low. So the first time you see it, you're like, that's neat, but I mean, come on. And then it's like when it comes back a second time, you're like, wow, that thing's still here. And then you're like, how does this thing work? And then you kind of like over time, you just kind of run into it more and more time. And so you actually think, okay, this is actually pretty interesting. It's the only asset that ever survived more like three 75% plus drawdowns and then went back to new all-time highs. I'm not aware of any other asset that has done that. Some of the best stocks in the world have done it once. Like they'll have like one big 80 or 90% drawdown, and then they'll come back, usually associated with the dot-com bubble. Some of the best companies in the world have done that, but I don't know any asset that's done that 3 times. So that kind of wakes people up. And I think it's probably on track to do it a fourth time in the coming years. So that was another piece. The piece that Egypt I think really helps with, and my connection to Egypt is that my husband's from Egypt. He's originally from Cairo,
Yeah.
and his family is much larger than my family. So, our economic centers in the U.S., but our social center, our family and friends are mostly in Egypt. Um, and so we go back and forth every year. We have a property in each country. Um, and so while I'm there, the financial side of my brain is asking every single person, like, how do you deal with this inflation? What do you save in? What is your banking environment like? Like I was doing a thing for a company I'm on the board for, and I was doing like I had to film something for them while I was there, so they hired a videographer. So I'm asking him, like, how are you dealing with like this inflation? And he actually was really animated. We got into a really long discussion, and it's been very useful. So basically, what that opened me up to was focusing more specifically on how kind of trapped they are in their currency bubble. That basically there's 160 different currency bubbles in the world, and dozens of them are very bad, right? So the top handful, if you're an American, you don't really have to think about money that often. If you're in another developed country, you still think about the dollar occasionally, usually because commodities and things like that are usually priced in dollars. And so most people have kind of two currencies in their head. But if you're in a developing country, you're kind of a financial officer in addition to whatever normal job you have. You're trying to manage things and thinking about things that Americans and Europeans don't have to deal with that often, which is the currency itself just rapidly losing value or at any moment risking a sharp devaluation. Um, and it's very hard for them to kind of save another asset. So if you're an Egyptian, your options for saving are challenging. So you're getting currency. The stock market is not like the S&P 500. It's not like this like, historically good performing thing. It's very volatile. It does generally go up over time, but it easily has lost decades. The overall kind of risk adjusted return of it is very messy. It's very hard to trust it. Um, uh, uh, Gold is an option for many of them. Actually, dollars are a huge option. A lot of them will buy physical dollars on the gray market. Like I know physicians, logistics managers, like upper middle class professional people will go to the gray market. It's almost like a marijuana transaction. That's the vibe of it, and they'll get these dollars and they'll just basically stick them under their mattress. And in the 21st century, that's what they've surveilled the landscape and decided this is one of my best kind of 12-month saving technologies is buying these papers and holding them. Longer term, it's gold jewelry, and then a lot of it is actually real estate. So they'll buy liquid real estate, often leave it empty, which is there's some degree of malinvestment there because you're just kind of buying it because you don't know what else to buy. Um, and so basically it's like kind of just realizing that when a country, and Egypt's 100 million people or 105 million, or it's a very large population center country. Same thing when you add up all if you look at, there's currently about 30 countries that have double-digit inflation right now, and they have ballpark about 1 billion people in them.
Mm.
So this is not a small problem. And if you kind of sample that over a 30-year period, it'll affect billions. Um, and so it kind of just hit home how siloed the financial system is. That basically their ability to get dollars, hold dollars in a bank account and trust it, or even be given access to a dollar bank account, basically be able to choose their own money, is kind of a limitation. The other key factor I realized was when people focus on currency destruction, they almost always focus on savings, right? You store money in cash or bonds, and then you're worried about that getting inflated away. Um, Another big problem is wages, as well as just overall pricing. So if you're a worker in Egypt, right? So money supply growth is about 20% per year on average. Um, if you're not aggressively trying to get a 20% raise every year, you're being diluted. Like your share of the monetary network is diminishing, and you're on the wrong side of the Cantillon effect, right? So your money's being basically siphoned away from you. Your ongoing purchasing power in global terms. So, for example, your dollar equivalent wages will be shrinking if you're not aggressively getting raises that keep pace with the Egyptian pound's devaluation, right? And that's true also for small businesses. So I know small business owners there, and I talked to them about how do they set prices and things like that. And it's just if again, if they're not raising prices on average 20% a year, right? If they're, let's say they're not a fast growing company, they're just a family owned, pretty static, middle class, upper middle class business, yeah, making ends meet. They're selling products. If they're not raising prices by 20% a year, um, while their costs are also facing issues, they're also getting diluted, especially in global purchasing power terms. Um, and the same thing is true for if you're a landlord and you're not raising rent aggressively on your tenants, you're getting diluted. And that's hard because a lot of landlords actually know their tenants, especially there. I mean, a lot of times their tenant is a family member.
Mhm.
And so um, basically, what a rapid currency dilution environment does is it puts every single person in that country on a treadmill to run as fast as they can to keep up with it, not just in terms of where to put their savings, but also how to continually increase their wages so that they're not just being completely left behind in global purchasing power terms, actual kind of international wealth accumulation, like richer on a global scale, the ability to travel outside of your country if you want to, for example, the ability to buy high quality imports like computers or cars or things like that. Um, and so that the importance of that wage component when it comes to inflation hit home harder if I had not kind of directly experienced that environment and talked to so many people that I'm close friends and family with. Um, and of course, the same thing is actually true in developed countries. It's just more subtle. So in the United States, money supply grows at about 7% a year on average. And let's say money supply per capita, right? So if money supply is growing at 7% on average, money supply per capita is probably growing at 6% on average. If you're not keeping up with that, you're becoming a smaller share of the network. And there are other people that are, say, closer to the source of money creation, bankers, large corporations that can issue tons of long duration cheap debt. They're basically shorting the currency that you're earning your wages in. And they're getting outsized. They're outperforming that, say, 6% hurdle, while the average worker is struggling to keep up because anchoring bias is towards zero. So if I'm an employer and an employee comes to me and says, I want a 6% wage increase, my natural result is, I mean, are you 6% better than last year? And of course the answer is, they're like, well, no, but money supply went up per capita 6%, and I'm as good or better than I was last year. In fact, I should ask for a 7 or 8% raise because I'm a little bit more productive and more experienced, and I just want to keep up with the currency dilution. But that's not how things work. And so having this kind of constant money supply growth just kind of makes it so that if you're not a financial asset owner, especially if you're not a financial asset owner that's also shorting the fiat currency with long duration, low cost debt, you're kind of not playing the game. Or at least you're kind of blocked out of the winning strategy. And that's, that's why I consider money broken. It's basically the people who usually earn the most for the least effort are the rent seekers, basically the arbitraging this gap. Whereas I think a better world is where people that invent things, or people that run effective businesses, or people that are really good at their job. That's the type of people that should really succeed in this environment, rather than kind of arbitrageurs and financiers and leveragers and things like that. And so that's why overall I think money's broken, and that experiencing developing countries, not just Egypt, but Egypt's the one I have obviously the most experience with, really kind of helps with those details.
Well, Lynn, I mean that's I couldn't agree more. As I've said, I just returned from Dubai, and it's been my first time in Dubai, and I was actually shocked how positive the sentiment was. Yeah, if you talk to Uber drivers, if you talk to waiters, if you talk to business owners, to expats, and I mean, there's I think only like 8% local population there, but everybody is extremely positive, upbeat. Everybody's only seeing opportunities. Wants to be successful, wants to set up new businesses, wants to cooperate. While over here in Europe, it's completely the opposite, I would say. It's extreme pessimism, and it feels like and I think the word depression also, it's not only the economic part, but also the psychological part, obviously. And this is what it's uh, feels like over here. But I think what was really interesting to see in Dubai, I held a seminar for the Dubai Gold Exchange, and there were gold traders from Turkey, from India, from China, from Arabic nations. There were two Egyptian guys, yeah, lovely guys, and it seems that the sophistication when it comes to gold, and also the time preference, not just caring about the short-term swings, but really understanding the long-term view. This is really something that's completely different to the Western world, where everybody's just staring at the intraday charts, it seems. Yeah. People couldn't care less about that over there, and there's this saying that gold always goes where the money is, and it went to Europe um, after the Second World War, where we've seen the growth and economic optimism. It went to the US in between the two world wars, and now it really seems that it's going to emerging markets. And we wrote a large chapter about it in our previous In Gold We Trust reports, just showing the gold flows and the importance of emerging markets. For example, just China and India were responsible for 28% of global gold demand 20 years ago. Now it's 50%. And it's not only consumer demand, it is also central bank demand. The People's Bank of China officially has bought roughly 600 tons so far this year already, but it's also the production side. So I think it's really crucial to also have the perspective, not only from the Western world, but more and more from the developed world. And I was in Cairo last year, and if you see a city with, it is said to have like 25 million people, and if you're talking to people there, I think it gives you a totally different perspective. While when I was on vacation with my family this summer in Florida, I always, asked myself when I walked around, how many people here actually realize that lots of the wealth that the US has accumulated is actually due to the fact that they're issuing the world reserve currency. I think it's very, 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 very few. But Lyn, let's come back to a chapter that you actually wrote for our 2021 In Gold We Trust report. It was called The Long-Term Debt Cycle, and you completely nailed it. When you said that, first of all, that we're seeing that long-term fiscal but also monetary policy regimes kind of string together over the decades, and they're now at some point of some degree of a breaking point. And you brilliantly described, the inflationary threat that we were seeing. And I just reread that chapter, and it was really brilliant and spot on. So just as a little update to this topic of the long-term debt cycle, now with the US, I know obviously China is not doing so well. Europe, to large parts, is already in a recession, while the US held up really well. On the other hand, I think the budget deficit is roughly 8%. When you officially have full employment, so of course there's an enormous amount of fiscal stimulus. Now we're seeing that the GDP now for the fourth quarter is 1.2%, so it's clearly trending down. But then on the other hand, we've got elections coming up next year, and I think it's gonna be a really nasty election campaign, and I think it's gonna be really really dirty and hard to follow. However, so what's your view on this long-term debt cycle? Where are we, and what would you expect when it comes to the US economy over the next couple of quarters? Are we entering a recession?
Yeah, it's a good question. I think that what makes this environment more unusual is that on the monetary side, there's so much tightening. So if you're in an interest rate sensitive industry, if you're doing commercial real estate, if you're doing residential real estate and you're dependent on volumes and turnover, if you're a small business that has to rely on bank credit for your financing, these areas are struggling greatly. And many of them are in, if you do industry by industry basis, many of them are in deep recessions as it and have been. On the other hand, if you're not very interest rate sensitive and you're on the right side of the very large deficits, you're pretty fine. If you're in the military industrial complex, if you're anywhere kind of near DC, if you're in, kind of just a lot of other kind of just real world businesses. And a key example I like to make is that, if you're an upper middle class retiree or near retiree, for example, you've built up a lot of assets, you own your own home, you might have a low fixed rate mortgage attached to it, and you own a lot of, say, money market funds and T-bills and stuff like that. Higher interest rates actually stimulate you because your debt is still fixed,
Mhm.
any debt you might have, while now you're actually making more income from your investment. So the government's interest expense is someone else's gain. And that doesn't that doesn't have the same sort of velocity or propensity to spend that, say, a stimulus check to a kind of working class person would, because they're more, their income and expenses are roughly matched. And so if they get a burst of income, they're likely going to spend it on consumer goods quickly. Whereas if you're wealthier and you get more money, you don't necessarily spend all of it. Some of it might just be saved. However, you're more likely to do international travel. You're more likely to buy luxury goods. You're more likely to help your kids and grandkids. Like if one of them is struggling and they have a wedding coming up, you might chip in. You might help them get their first house. Um, and so that money does enter the economy. It's just in a slower way. And so we're seeing this really sharp divergence between fiscal policy, which is very loose, and then monetary policy, which is pretty tight. And then ironically, the tight monetary policy feeds into the loose fiscal policy by blowing out the interest expense of the government. And so if I take a step back, the long-term debt cycle is fascinating. And that's part of what I started studying aggressively after 2017 to figure out how this normally works. Because if you go back and look at the prior major long-term debt cycle in the US and much of the developed world, which would be the 1930s and 40s, um, these debt bubbles tend to happen with a one-two punch. So
Mhm.
first, you get decades of private sector debt accumulation, very, very high leverage ratios. And eventually, when interest rates hit zero, when that's still not enough, it all blows up. And that's generally a disinflationary environment because credit is being defaulted on, which destroys part of the broad money. Banks are failing. That's a very disinflationary environment. But what happens is that becomes intolerable to people. And they basically, there's like this rising populism, um, and kind of everybody focuses on what to do about the pop bubble. No one focuses on why the bubble was caused in the first place. But the end result is that they end up basically printing a lot of money. A lot of that debt eventually gets transferred to the public sector, right? So there's bank recapitalizations, there's stimulus programs, there's decreased tax revenue from so much economic kind of stagnation, while expenses are still often relatively fixed or increasing. And so a lot of that debt doesn't deleverage nominally as much as you'd expect, and a lot of it gets transferred onto the public sector. And a decade or two later, when the public sector is over leveraged, that's a very different environment. That tends to be more inflationary environment because whenever they kind of run into an inflation problem, the normal approach by a central bank is to raise interest rates. But if there's so much public debt, that actually blows out their interest expense even more,
Mhm.
and it increases fiscal deficits, which can be stimulatory and inflationary. Um, and so that's the environment that we find ourselves in, which is that, the whole 2008 crisis and the decade that followed was the disinflationary private sector debt bubble. And a lot of that debt was transferred to the public sector in terms of bank recapitalizations and stimulus programs and hurt tax revenue and all that kind of thing. And now we have a demographics issue. So the baby boomers are retiring, and so they're consuming and not producing as much anymore. And so that's a strain on the system, both in terms of Social Security, Medicare, and just overall consumption relative to workers to produce them. unless or until technology can fill that gap. Um, and so basically a sovereign debt bubble, as it starts to become untenable, starts to actually be inflationary. And the kind of way to think about that is, in the United States, the past 40 years saw higher and higher debt as a percentage of GDP and lower interest rates. And that combination actually kept interest expense pretty static, especially relative to percent of GDP. And so the problem is when you hit zero and then you start going sideways or up in terms of interest rates, while the debt as a percentage of GDP is still increasing and there's still very large deficits, that's when you start to run into a fiscal spiral because you're paying higher interest expense on your large debt and deficits. And that's where the United States finds itself. The United States also has a trade deficit structurally. And so you have very large twin deficits, double-digit percent of GDP twin deficits, which are kind of recipe for a problem. Now, that's offset by the fact that the US is the global reserve currency. And so by default, central banks around the world hold the currency. Like I said, Egyptians on the gray market will go buy dollars as though they're buying like marijuana. That's kind of and they're not buying, Chinese yuan. They're not buying
Yeah.
Indian rupees. They're specifically they're not buying Canadian dollars. There's a very strong network effect around the dollar. A little bit in that region, a little bit the euro, a little bit in say the UAE's currency, but mostly the dollar. Um,
And
and so
the UAE's currency is also pegged to the US dollar. So
Yeah, exactly. And so you have that kind of there's that global demand. There's also something like $13 trillion in official BIS estimated dollar denominated debt, which is all basically inflexible demand for dollars. Servicing that debt, any hope of paying that debt back is all demand for dollars globally. And so there's this kind of like tug of war between the United States running this big fiscal kind of train wreck while there's still demand for its currency, and then the rest of the world kind of slowly trying to get off of that, um, with the caveat that network effects are very powerful, right? If we all agree that we don't want to be on Twitter or X anymore, we want to go build this other system, it's hard to have that happen in critical mass,
or change
because
the world language. Yeah.
exactly. Yeah. If we all
English
decided, look, we don't want to be English, we don't
cannot.
want to speak English anymore. We want to speak
Yes.
Mandarin. That's gonna be incredibly unlikely. So however you measure it, it's very hard to do and it takes time. Now financial things can, but languages don't break, but financial things can break. So language is probably the hardest network effect to change. Finance is not that hard, but it is a very hard thing to change. And so that's kind of this dilemma we face ourselves in, which I think that the developed world, because there's so much sovereign debt now, and then especially the United States, which is running very large kind of fiscal deficits, is likely to have above target inflation for a while. And I think it's only going to really go below their inflation targets during kind of recessions. That basically, whenever they're not in a recession, whenever they're in a period of economic expansion, it's likely to have inflation associated with it because there's very large kind of fiscal deficits, and then there's very tight commodity supply side, infrastructure supply side, worker supply side. These things are more constraints against those very large fiscal deficits. Europe has its own issues where there's generally less fiscal deficits, but also less energy security.
Yeah.
Um, and Japan they're kind of on their own drum where they have better energy security than Europe because of better policies. They don't really shoot themselves in the foot as much as Europe does with its own energy security. Um, but they, of course, have very high public debt. And so they're kind of in the same trap where if they raise interest rates, ironically, it can actually potentially be pro-inflationary because if you have 250% debt to GDP and you raise interest rates, you're actually pouring more and more money out into the private sector, somewhat offset by the fact that you're also you're pulling some Japanese capital home because Japan has decades of accumulated trade surpluses. They have a positive net international investment position. They've invested all over the world. So raising interest rates is kind of a two-edged sword for Japan because if they raise interest rates, it makes especially Japanese people more likely to be fine holding the currency relative to FX hedged foreign currency and things like that, foreign bonds. But it also means that their deficits are going to completely blow out because their interest expense becomes untenable. And so that's basically the whole Western world, including Japan in this context, so the whole kind of developed Western aligned axis. is just facing kind of a long-term fiscal issue, which is, I think, ultimately resolved by inflation. Like
Lyn,
that's basically the, yeah.
in your book, you've got a section on the fiscal spiral, and you mentioned the possibility to actually for the government to revalue their gold in order to recapitalize the balance sheets. First of all, how exactly would this work, and do you think that we are really close to such a historic decision, or is this still 5 or 10 years in the future?
So I would say it's probably in that 5+ year range. These things are non-linear though, so I wouldn't be shocked if it happens 3 years from now or 10 years from now. I don't think it's going to happen in the next year or two. So every country has a different legal structure for how it works. But for example, in the United States, and Jim Ricker just talked about this, basically like there's and Luke Groman has talked about this, and I've went and I've looked at the Fed manual myself just to kind of see the text and see how it works. But basically, in the United States, we have the Treasury General account, and that's basically the federal government's like checking account. When they issue bonds, the money shows up in this account, and when they spend money, it comes out of this account. And so that account has varying cash levels based on what's going on. And a general trend is that you in the United States there's enough kind of legal structures in place that you can't just print money without creating associated debt with it, right? Debt basically money comes into existence largely because of debt. That's how they've structured the system. But the one of the very few workarounds is a gold revaluation. So if the Treasury instructs the Fed to change the official price of gold, um, then basically that fills the TGA up by that amount. And that's basically creating money without creating associated debt. Instead, what they've done is devalue their currency officially. And for starters, they could increase it to the current price of gold, right? So instead of being $42 an ounce, they could make it 2,000 an ounce. Um, and that gives them several $100 billion to spend without increasing debt, which is when that happens, it's pro liquidity, it's pro inflation, it's stimulatory, it's a currency, it's a mild currency
That's
devaluation.
like, that's like the deficit of a couple of months these days. So it's
Yeah,
doesn't
yeah,
really move the needle.
exactly. And so the next step would be saying, okay, well, gold official price is now double.
Mhm.
And that would eventually, and then, you know, that doesn't necessarily affect things right away, but what it does is now the government has like $1 trillion to spend without issuing debt, which is, that's imagine $1 trillion stimulus. That's a decent amount of stimulatory, inflationary type of ex monetary expansion. That would probably be good for gold, Bitcoin, commodities, real estate, equities, and not great for cash or bondholders. And basically, the more that's basically the kind of the reason why it's not linear is because if that happens, that can instantly change everyone's perceptions domestically and globally, right? So the at those small numbers, the effects are material, but not like, huge. But if you're a foreign creditor nation holding a lot of treasuries and they do that, that's the kind of thing that can change the reserve currency system in a similar way that freezing Russia's reserves after they invaded Ukraine. These are kind of like historic moments that actually a lot of countries in the world say, wait a second, there's more risk here than I had thought in the prior day, right? And so that's basically a mechanism that any country with gold on its central bank or on its kind of sovereign finance minister balance sheet that they can do. They can revalue their currency relative to gold. They all have their own legal mechanisms, either written or implied, that they can turn to. And, that can kind of reset the problem. And then you can raise rates from there to get back to a period of kind of real rates and austerity. Uh, but then the question is, have you permanently destroyed trust in that, right? So the 1971 event damaged trust, but it didn't permanently destroy trust. I mean, basically, in the 80s, well, the second half of the 70s and the 80s, they got the world to accept treasuries and dollars again. Um, and so that's kind of the gamble that they would have to do if they got to that environment. I think we're still a long ways off because before they would do something like that, they're going to drain the reverse repo facility. And then there's other kind of levers they can pull. They can change the kind of leverage ratio for banks to allow banks to hold more treasuries. The Fed can kind of like the 2019 repo spike. They can go back to kind of slowly accumulating treasuries and saying it's not QE, it's for financial stability, or kind of just, they can kind of hand wave things for a while. And it still has material effects. It's still pro liquidity when they do things like that. It's all else being average, it's pro inflationary, pro liquidity, you know. And only when really kind of things get truly messy, I think would they risk kind of resorting to that kind of gold lever if they even pull it. I mean, there's all sorts of mechanisms they can do, from yield curve control to gold revaluation, but these are kind of historic things that have happened in the past, have happened in our kind of parents and grandparents' lifetimes, that we assume it's like crazy to even talk about today. But I think that these types of things will be happening in our lifetimes.
I,
And yeah.
I think nobody would have expected, 18 months ago that the Federal Reserve would be able to raise interest rates that aggressively without completely crashing markets. And, I just had a look at, most of the 2024 outlooks, and it's Goldilocks all over. Everybody's super optimistic, soft landing, the S&P goes to 5,000, 10-year treasury is going down to 320, something like that. So everything's fine again. But I think it's, in the end, it's all about the credibility of central bankers. And somebody once said that central bankers are the high priests of our monetary system. At the moment, everybody believes that they manage it really well. But Lyn, two more things that I would love to discuss. We're kind of running out of time, but two questions. First of all, regarding Bitcoin, we've got the halving coming up, and there's probably lots of ETFs finally being issued, probably at the beginning of next year. And I think this will probably be the next stage of adoption, especially, in the, let's say, in the mainstream financial world, where actually, if you're a financial advisor, you can say, well, all this stuff with the wallets, and that's too complicated. But if there's actually an ETF, a Bitcoin ETF, issued by BlackRock or Fidelity, that's actually really something that I can recommend to my clients. So a brief outlook. What's your take on Bitcoin at the moment? I know that there's still very few people that actually like Bitcoin and gold. We got lots of criticism from the gold camp, but also from the Bitcoin camp. It's a very, very emotional discussion. From my point of view, it's gold has a pretty long track record as money and as monetary insurance, while Bitcoin is hardly a teenager, but so far it's doing tremendously well. So a quick view on Bitcoin, and then perhaps also what excites you most for the next year, for 2024, and what's kind of worries you the most for the next year in terms of investments.
Yeah, so I'm one of those people that likes both gold and Bitcoin for different reasons. I think they serve different purposes. Um, and for Bitcoin, I think there's a number of factors that are very shaping up to give it the next bull market, which basically the spot ETF can add demand for it. So any sort of commodity futures ETF generally has problems with performance compared to the underlying commodity. And so they're not super attractive. Uh, Bitcoin in like over the market trusts is also not super attractive to advisors. So an actual like exchange listed spot ETF by a major financial asset manager is a big deal for accessing tens of trillions of dollars of kind of capital that's currently not really allowed to invest in Bitcoin related products, other than maybe some miners or MicroStrategy around the margins. And so that is, I think, a new source of demand. The halving takes away half of the new supply. And then the other factor is just that during bear markets, the fast money all leaves and the long-term convicted money keeps buying. And so more and more Bitcoin ends in strong hands. So people that buy and rarely sell, and that literally kind of take cold storage of it and kind of do all that. And that ends up tightening the market. So basically, a lot of the liquid supply is kind of taken off, and it only takes a small amount of new demand to come in and the price starts moving a lot because a lot of those, like, I'm not selling my Bitcoin at current prices. So I'm kind of like a price and flexible holder, at least in the current, there's a very big band for where I would consider actually selling some Bitcoin. And there's a lot of people like that. And so that's kind of the hodl wave cycle that it goes through. The other factor is that in my research, Bitcoin is the asset that is most closely correlated with global liquidity. And there's a couple ways to measure that. Michael Howe from Cross Border Capital probably has the most sophisticated liquidity metric. The one I use is simply global M2 denominated in dollars, right? So if you look at global broad money supply denominated in dollars, you're basically measuring how much credit creation is happening, how much money printing is happening, how is the dollar doing relative to other major currencies, which matters because so many countries have dollar-denominated debt. That's the unit of account for the world for in many aspects. And so that is highly correlated with Bitcoin. When that's going up, normally Bitcoin's going up. When that's going down, normally Bitcoin's going down, especially when you look at these things in rate of change terms. And so having a view about liquidity helps if you're trying to have a positive or negative view on Bitcoin. And so overall, I view 2024 again as a mixed environment. There's some industries that are absolutely suffering and other ones that are just like recession, what recession? And so people are debating between hard landing and soft landing. I've been referring to it as an emerging market landing, which is if you look at an emerging market when they have a recession, what does it look like? Well, as the prices usually go up in local currency terms, they don't do well in dollar terms or gold terms. Um, Usually people are still relatively employed, but with a general sense that things aren't going well. Like their overall purchasing power is not great, even though it doesn't feel like a developed market recession in a way. It's not like this big kind of disinflationary cycle. And you have very kind of mixed systems where if you're a emerging market corporation that is like defaulting on your dollar debt, you're having a bad time. Whereas if you're an emerging market exporter, and you're selling things for like dollars and you're hiring people that you pay in the local devaluing currency, you're doing fine. And so there's kind of like a big spectrum between how it's like a very different type of recession. It feels very different. And so I think that developed countries are going through a similar type of landing, which is that I don't think it's like a big 2008 style disinflationary crash. Instead, it's kind of this like high nominal environment. But that depending on where you are in the economy, it can feel like a recession or it can feel like not a recession. And so generally, my view on Bitcoin and gold is constructive for the next 2 years. Rather than say a 12-month time frame, I like to give myself a 24-month time frame because that's how long I think this next liquidity cycle could take to play out, maybe even 3 years. But I expect basically Bitcoin to do well. I expect gold to do well. I've been tracking gold to see if it would break all-time highs. It has. Now the question is, can it stay above it? Can it retest it and hit a higher low and kind of keep going from there? It already has in most other currencies. And so I consider them at different speeds. So for example, I do expect Bitcoin to outperform gold over the next, say, 2 years. But of course, you're taking on more volatility to get that potential outperformance. And so I expect both assets to do well at their own speeds. Um, and I think basically I'd also look at certain emerging market equities. You have to obviously be very selective. I'm generally constructive on Latin America overall and certain parts of Southeast Asia. Um, and so I think that those are the types of areas where I think that there's value and opportunity.
Yeah, talking about emerging markets, obviously Argentina has been a big surprise. Let's see how it's gonna turn out. I've been in touch with quite a lot of people in Argentina, and Mark recently went to El Salvador, which is also extremely interesting and fascinating to follow if you think that a country needs sound money to really prosper and succeed. So we'll see how it's gonna play out. Lyn, thank you very, very, very much for your time. Now is the time to say where we can find you, what services you offer. Let us know a little bit more about what you do and where we can find you.
Sure, people can check out lynalden.com. I have a free newsletter that people can sign up for. It's actually pretty in depth. And then I also have a low-cost paid research service, Lyn Alden Premium. If people want more regular updates about the markets or specific investment opportunities. And then lastly, check out Broken Money on Amazon or elsewhere if you want kind of an overview over just how money works and a lot of things that people maybe haven't considered.
It's a great book. It's a great gift for Christmas. We actually bought it for a couple of our clients. I think it's really it's brilliant. And yeah, thank you for putting out such a great book. Thank you for all your work and thank you for taking the time. Lyn, I wish you yeah, Merry Christmas, a happy and healthy 2024, and also the very best to all our readers, listeners, clients, potential clients, and everybody that kind of likes what we're doing. We really appreciate all the feedback that you're giving us on all those various channels. And yeah, thank you very much for your time. And we really look forward to seeing and hearing from you next year. Thank you very much.
Thank you.
Goodbye.
Thank you.
Thank you.
Bye.